Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'm going to be your host here for about the next 25 minutes. But this week is crazy, and it is the Monday of the crazy week. We have, obviously, everybody knows that we're going to have an election this week. And then also we have the Fed coming out and speaking. And what's fun about the Fed is they're actually going to be on a Thursday because of the election. So they're delaying their meeting for one day. But what that has done in general has made the VIX very frothy. It's trading right up around the 22 level, and the market just can't really figure out where it wants to go. I've mentioned this many times, including last Friday, that the VIX, in my mind, has a stranglehold on the market. And every time you see a run up, people are running to the VIX to try to lock it in by buying protection. So because of that, the VIX has stayed very frothy, up around the 20 level, which I'm surprised to see that it's even that high. 22 right now, up about 14 cents on the day. And that's with the S&P 500 index being up. So even though it's up a little bit, the fact that it's up, I think, is important. It's just that there is a lot of nervousness around this election as far as the marketplace is concerned. And we've seen more than just the VIX. We've seen weird things happen in the interest rates. The Fed's cutting interest rates. It's highly anticipated that they're going to go another 25 basis points. And yet we still see the 10-year yield and all the other treasuries, to be blunt, drifting higher after this news. So it'll be interesting to see. We need some certainty in the marketplace. We need to get back to get the election behind us before the market can move forward. And I'm not doing anything political. I'm not saying Republicans or Democrats, if they win, they do this or whatever. It's just the known event. The market likes to know things. And this is one thing they don't know. So the marketplace is struggling with it. So today, I would normally do take a directional play in the S&P 500 index. I don't think I'm going to do that today. And I've been talking about this for quite some time, about the fact that we would, once we get past the election, I want to come in and be a little bit more standardized in the approach to the SPX trades that we're putting on weekly, and pick a direction for the week and go with it. I don't like it this week because there's too much news. So to try to come up with a strategy in the S&P 500 index, that'd be a little bit tough. Last week we did a butterfly in Amazon, and also a long call spread. Now, ideally, Amazon was announcing on a Thursday, and I've mentioned this many times that it's always fun because Amazon usually announces on a Thursday, and then you have one day for the option contracts to live, which is a Friday. And that's a speculative trade too. We don't, it's not a staple in my portfolio to trade earnings all the time, but we learn a lot from trading earnings because the dynamics of the option pricing, in that Amazon is a fairly high price stock. It's not $1,000 stock anymore, which even made it more interesting. Now it's a little bit frothy stock, if you will. And then once you put on the trade, you have huge implied volatility, which jacks up the option prices. You got a little bit higher stock that jacks up the option prices. And they announce earnings. And now all of that premium from the earnings report, from the price of the stock, all of that's got to go to zero by the end of the day on Friday. So it always makes butterflies interesting. It always makes almost every strategy kind of interesting to put together. The one thing I don't want to do on Amazon around earnings is just buy an option outright because of that scenario, using the one-day options. Obviously, if I were to buy an option outright, I would just go out much longer in time. That would be my forecast in Amazon. So we actually hit on the butterfly that we set up going into earnings, dead center, actually, right on the 200 strike. And then our long call spread was just a little bit short. Okay, so that's a long walk to on a story that could have been shorter. In that we did that. We did okay. I was much more bullish in Amazon, and I actually kind of highlighted the fact that they just haven't gotten the respect in the AI space that they deserved, and that if they mentioned anything AI and what they were doing, that the stock would probably go up. So on a strong down day, which was the Thursday before their earnings, the stock actually did extremely well because they mentioned everything that they were doing in AI. They actually did what I was kind of hoping they would do. And so, with that said, first of all, in Amazon, if you want to just buy Amazon outright, I think it's not a bad purchase, because of the earnings and the strength. And there was really nothing bad in the earnings report. It's still a little frothy. But then again, all the Meg 7 are, except for Google. Google's about the only one that's kind of hanging in the Meg 7 that isn't considered a, overdone valuation. So don't mind just owning it. Okay, so now let's get to the moral of the story. Palantir. Palantir is announcing today, if you want to put a trade on, because I don't really want to do anything else. I'm going to go back and relook at the VIX trade that we talked about on Friday, mainly because the VIX is up again. I've added to my position this week because I did not expect the VIX to get above 20 going into the election. I thought it would hang right around where it was prior to that, which is between the 18 to 20 range. But now we're seeing the VIX actually drifting even higher with the known election, with the known event coming. And another way, but then again, that's not abnormal, right? If you look at earnings, you don't usually expect the highest implied volatility to be the day before a company announces earnings, as opposed to a week before. So I guess if I think about it, put a little bit more thought to it, this isn't abnormal that the VIX is trading at 22 today, heading into this week. So, but here's the one trade. So we can do this so that we have a trade to talk about on Wednesday. I'm not as bullish on Palantir and don't know the stock as well as I did with Amazon. But if I look at the chart is a little bit bearish, actually. And we could do this to the bear side too, but mainly because here is the 20-day moving average, and here is the 50-day moving average. And we actually did break through that. We do see a little bit of support right around this level, right? See this right in this range. Not bad. There's a couple of times that it's came down and bounced. The stock is up today, and I'm going to scroll back out again. Let's go and restart this and look at this trading period right through here, right? So I'll zoom in a little bit this way. And so I guess you could look at it as, earnings is going to be big in Palantir Technologies. We're still, what they say in the conference call is going to carry a lot of weight, just like it did in Amazon. Now, we're right on this range. I guess we'd call this choppy. So if we did break through the 20-day moving average, which isn't a good thing, but it's not like in a vacuum, that's not that big of a deal. So I'm going to do a very low cost modified butterfly in Palantir. So there's a lot of volatility. It's a very volatile underlying. We're seeing implied vols on the at the money option contract back here at 157. If we look at what the long straddle is, we'll call it $6, 280 and 280. I guess we'll say 560. So 57 would be a 5-point move, right? And a 6-point move would be 58. And I say that only because the only reason why I'm running off is because of the strikes. So the expected move, remember that it has no regard to the direction. If you bought the at the money call and you bought the at the money put, would be around $6, between 5 and 6. So $42 here plus 6 would get you to 48. And that's fairly important because of the way that we're setting up our strategy. Now, if it's 5 points, it gets you to 47. We're going to buy something that's going to stay with it, that's feasible according to the marketplace to get to our strike. So the trade that we're going to put on, and I'm going to show you this in the options playbook because, like I said, I'm not going through as many trades today, so I'm going to have a little bit of time. And I'm going to try to explain this. We also did this with Amazon. We set up one of these. It wasn't the official paper trade for the day. This will be the official paper trade for the day. Palantir, they're announcing earnings after the close today. So here's the modified butterfly that we're going to do. We are going to buy the 46 strike call, which is within the expected move, 47, 48, somewhere in that range. That would be the expected move. And remember, once again, expected move doesn't have any regard to direction. But if it were positive to the upside, Marketplace says that this is a feasible price that the stock could move after earnings. Then 49 is right at a 1 standard deviation move. If I look at the delta, we're looking at 18 delta. So that's plausible to get to 49, and we don't mind that at all. As a matter of fact, if it blows through the number and does a 2 standard deviation move, the way that we're setting up this butterfly, we're okay with that too. So if it blows through the 49, goes up to the 51, now we're talking about, and we'll make this 40 cents. Just to make and it moved. That was nice. The market was listening to me. So it moved to 40 cents. So in this instance, we are going 3 points wide on our butterfly. And that's the only thing that makes me a little nervous because I'd like to be 4 points wide, but I don't want to, if I go 4 points wide, it's going to be fairly expensive to put it on. And I really want this to be a cheap trade because it's just pure speculation. We're basically doing it because they're announcing earnings tonight. I don't have any real love for Palantir or dislike for Palantir. I'm just saying that they're announcing earnings tonight. So we're going to put this trade on. 46 to 49, that's 3 points. Now for 49 to 51, that's 2 points. Interesting. So our short spread is shorter than our long spread. Say that again slowly. Our short spread is shorter than our long spread, which means when we go to the what if calculator, and I'm going to show you this. This is the trade as of today. This is what it looks like if you put it on. The stock is right here. Where's the stock? Right here. No, stock 46. 41. So yeah, okay. Let's go back to the what if calculator. Yeah, there it is. Last trade, 41.87. That standard deviation was screwing me up. 41.87. This is where the market is at. If it comes up to the 46 level, we have 4 days left to expiration. That's a lot. So you got all day Thursday, or all day Tuesday, Wednesday, Thursday, and Friday. That's makes me a little bit nervous too because they're announcing on a Monday. I'd rather it be a Wednesday or with Amazon a Thursday where you just have all that time premium come out. We're trading at 150% volatility, but I don't really mind if it blows the numbers away and it starts drifting higher because if it does, the butterfly is going to be trading for $1. The long spread is $3. The short spread is $2. 3 minus 2 is 1. We're paying 40 cents for it. So if it blows through our 51 strike, our high strike in our call butterfly, we should see this butterfly trade for about $1. We could get out and make 60 cents. If it goes to right here and we get close to expiration, now it's got to get there closer to the expiration date and hang out, if you will. Well, then in that instance, this could be trading for $3. We paid 40 cents. So $2.60 would be the maximum. If I'm putting this on and I'm doing it for 40 cents and I can sell it for $1, I'm going to get out. I'm not, this isn't a trade. We're going to take that we're looking to make the home run, make the $2.60 on the trade. That's not the goal of this trade. And that's always true with butterflies. You got to take your money when the money's there to take. So in this instance, my goal would be if I see this trading for close to $1, I'm going to get out of it. If I had a boatload of them on, let's say the boatload to me would be 10 in this instance. If I did 10 butterflies, 10 1 by 2 by 1 butterflies, I might take 3 or 4 off when it gets to 1 And then if it trades a little bit higher, I would take a few more off. And then I'd let one ride to see if we actually landed on the strike, if everything was going well. If it goes to the downside and we're dead wrong on our forecast and it goes this way, guess what? We lose 40 cents. So you're not going to salvage 20 cents on this trade. If the market opens down the expected move, which we'll call it $6, then I would expect this thing to be trading for next to zero. And all I would do is just let it ride and see if it can make its way back towards that strike. So that is going to be the approach with the strategy. This is going to be the official paper trade as far as this is concerned. And that's what we're going to end up doing. All right. So let me now, if you've got any questions, please do throw them in the chat box. I'm obviously traveling. That's why you're looking at my picture there. And if you do, our producer will let me know that there is a question in that chat box about this trade. Okay, let's move on. Now, I'm going to back out here just a little bit. You're going to have to, you're going to have to look at my inner workings of my computer because I just got my picture up here. But let's talk about the VIX. Oh, let's do the butterfly trade. Okay, so I said that I could explain this a little bit more, and I can do that. Okay, so here's my website, optionsplaybook.com. Here's what a long call butterfly trade looks like. We put together just a standard if we put together a standard butterfly, the stock would start on the profit and loss graph down around here. Below strike A is where that would start. And we'd want it to go to strike B, which we showed you in the what if calculator in the Tradier Pro software. Okay, so now here's what makes up a butterfly, right? Here's the long call spread. And that in this instance is if we bought strike A and sold strike B, that would be our long spread. Buy strike A, sell strike B. So that is the first part of a butterfly. I'll go back to here. Buy strike A, sell strike B, buy strike A, sell strike B. Now that's on a one-by-one basis. Now, where's the second part of the butterfly? This is what makes the butterfly cheap. So you got to pay for the long spread, but then you bring the short spread in and you say, all right, now I'm going to sell strike A, another option contract, and I'm going to buy strike B. So if you look over here at the butterfly, I'm going to sell strike B and buy strike C. Okay, in this instance, that would be strike B, and this would be strike C. So you put that trade on, that's your long spread. You sell your short spread to help pay for the long spread, and boom. Now what do we have? We have one at strike A, two at strike B, and one at strike C, and hence you have the butterfly. So what happens if this is 3 points wide and this is 2 points wide? Well, then you modify. That's what I call a modified butterfly. That would be my term for this strategy. And when you do that, you are not bringing in as much as you would for the short call spread, right? Because you're making it tighter. There's less risk on the trade, and that usually means less reward when it comes to options. So you don't bring in as much, but you open this up. You bring this over here just a little bit, and now the long spread, which pays you when you're right, gives you more reward than the short spread would take away if you're wrong. Right? Let's say that again. So the long spread that pays you when you're right would be more than what the short spread would take away if you're wrong. But overall, you have to pay more for the butterfly. That simple. All right. So that was just more detail using the options playbook on the two trades that we looked at. We looked at one in Amazon, and somebody said that they did the trade inside the chat box last Friday. And then we did another one just today in Palantir. So that is the modified butterfly in my mind. Now, I told you about this article on Friday, and I'm well, maybe I'll grab this if I can. And this is the decoding the VIX. If you're going to do the VIX trade going into earnings, which this is probably one of my bigger positions that I have on, getting bearish on the VIX after earnings. And I'm just a little bit nervous about the timing of the trade more than anything. The fact we're going to be using the November 20th expiration, if this is a real contested election and it's extremely tight and nobody concedes, this would be a that I don't know if I have enough time. That's my issue. So you know what? Actually, I might go out and go beyond November and go into December and maybe hedge myself by giving myself a little bit more time for the VIX to come back down towards the 15 level. Is what my hope is. Now, here's the Fed watch meeting. It tells you the days and hours until you get to the meeting. This is the CME Group website. And if you scroll down, you see that they're still looking at, this is where the current rate is at, which is 40. We'll look at this number is at 500 as far as basis points is concerned. And they're saying they're going to lower it a 25 basis points to 75. And they're saying there's a 98% chance that that's going to happen. And then they're actually saying there's, according to the futures, this is the futures. If you add this number and this number, which is a 50 basis point cut, that adds up to 100. So they're saying there's no chance right now in the futures market. There could be a rogue Fed chairman that wants to come out and try to push it high. But bottom line is the futures market does not think that there's any chance at all that the interest rates will stay the same. That's what the marketplace is saying. If you add 98.3 to 1.7, they're saying it's either going to be a 25 basis point cut or it's going to be a 50 basis point cut. All right, and here's the decoding the VIX. So let's go in and we're going to go back and look at the trade and we'll review the trade. Yeah, my handle, by the way, is at Brian Overby in the X.com platform. If you want to check those out. I'll see now. I don't know how I can pass that on to you in StreamYard. All right. Well, you can look for it. Decoding the VIX. Go under my profile and scroll down and you'll find it. All right. We'll just leave it there. Trying to figure out a good way to get it to you, but I can't because I only got one computer screen that I'm working off of today. Here's the VIX, VIX, and here's our trade. We went in on Friday. We looked at the November 20th expiration. So is 15 days enough to determine a winner in the election? That is the ultimate question. I do not like to trade the weeklies. I've mentioned that more than once. They're just not liquid enough. And you notice the reason why I'm doing this is I'm pointing to the W. The W implies that it's a weekly. If it's just green and it's VIX, those are the more liquid option contracts. They make the most sense to me. Those are the ones that have been around since the start of the VIX index and VIX index option trading. So an alternative is to say, well, I'm going to go up 44 days, but the futures contract will be much different on the 44-day option contract. And I kind of came up with that today, but I might think about putting a few of these on in my own portfolio going out to December, 44 days away, just in case it's a really highly contested election. That's the only thing that makes me nervous about this, because I would expect the marketplace needs to know who the next president of the United States is going to be. And in 16 days, there's a chance the marketplace might not know. There's obviously that probability. And it's probably the reason why it's staying a little bit more elevated, honestly. So I mentioned on the show on Friday that if you want to know where the VIX is trading at, as far as the futures market is concerned, you got to do something that's called a combination. You need to look at, okay, let's focus on the asking price of the call. The asking price of the call option is 247 here. On the put option, it's 180. And then the asking price of the 20 strike call is 207. And on the put, it's 241. So as far as the futures are concerned, even though we saw the spike up in the VIX today, the actual spot being at around 22, the futures didn't really move much. The futures is trading between where the call is expensive here and the put is expensive here. So it's probably around 19 and a half. Now, I have mentioned that, okay, so the CBOE used to give, if you typed in VIX NOV, you would get the VIX futures quote as an index, and it would be delayed, but you would get it. They stopped publishing that, and I don't know why. I asked them to publish it personally at a retail markets committee when I was working for a brokerage firm. And then they stopped. And then they used to have a website, if you typed in CBOE VIX futures, where they'd give you delayed quotes on the futures. And I checked that out this morning, and there's nothing. There's not even a template for the futures anymore. So I don't know why they've decided not to publish that information, but they don't. So this is the only way that we can really figure it out. And okay, I guess I can go in a little bit more detail. Well, if you're buying a long call, that allows the stock to go up. If you're selling the put, let's hit this, that wants it to go down. So 66 cents. So here's the way it is. If you buy a call and the stock is and the VIX index is above 19, and if you buy that call and it's above 19, you can exercise your call and buy it at 19, meaning that you're going to own the VIX index at 19, if that was possible. You can't buy the VIX, but if that was possible, okay? If you sold the put at 19, if you sold that put, that means if the market went down and it was trading at 15, they could take it at 15 and put it to you at 19. And guess what? In that scenario, you own the VIX at 19. So no matter what happens here, you own the VIX at 19. If you buy the at-the-money call and sell the at-the-money put, it's synthetically long stock in the VIX. That's exactly what this trade is. It's called a combination. Other terms that are used are put-call parity. But bottom line is, this is how to use the options market to synthetically buy the VIX. Just that's the way it is. Now, this is a net debit of 66 cents. So because it's a debit and we went below, we used the 19 strike. You would take 19 and you would add that net debit of 66 cents. And you'd be at 1966. And like I said, the VIX was the futures trading somewhere between 19 and 20. The actual numbers, now that we've done it using the midpoint of this trade, is 1966. And that's where the November 20th futures contract is trading right now. The spot index, which is the settlement value in the VIX on that Wednesday in November on the 20th, is 22. So ultimately, the futures and the spot have to converge. And on expiration, the VIX index means a lot more. But right now, it's all about the futures, and that's what drives the price. So we came in, and I'm wondering, actually, this should probably be close to where we were at. I think the VIX future was actually above 20. It might actually be a little bit profitable right now. So let's close this, and here's the trade that we did. We're shooting for the market to get below 16 by after that election. That means that we're going to buy this one and we're going to sell this one. 129. That's about what we paid for it. I think we paid 122. So we're up 7 cents from Friday. But this is the paper trade that we've talked about on Options Guy TV. It's a very, very risky trade in that it's in the VIX. You are either, it's an all or none. I'm 3 points wide. I'm trying to make $1.70, or I'm willing to lose $1.30. And that's that simple. I'm not going to try to salvage it. I'm not going to, if I'm down 60 cents on my long put spread, I'm not going to get out. I'm either going to make it or I'm not. And if it settles somewhere in the middle, it's a cash settled index. Oh, well. So basically, if I look at this, if I got an opportunity, if the VIX for some reason went down to 13 after the election, let's say it did, that'd be very fictitious. But if it just moved down to 13 and I could get out and I could sell this thing for 290, I would do it. I would get out of the trade. But on the losing side of things, I'm prepared to lose $1.30. I'll close the winning trade, but I'm not going to do anything to adjust the losing trade. That simple. Okay. So let's look at this one. What time we got here? I hate this one screen. Oh, I'm way over. But I'm curious about the VIX just for my own. So if I look at the VIX in December, where is the futures contract trading? Okay, the VIX is at 20. We go down to here. The futures higher here too, right? Okay, so it's right. No, it's right at 19. So it's still hanging right there. Okay, so in this instance, the 19 call is 270 and the 19 put is 276. So it's basically, they're the same price. It's right at 19. So the futures for December is at 19, which does make it feasible. So it's a little higher in November, right? It was 1966. Here it's trading fairly close to 19. But if we bought this should maybe be $1.50. Let's see where we're at. Let's buy and sell. $1.73. Yeah, it's not that exciting. I'd like it to be $1.50. Wow. All right. So you would be paying $1. So we'd say 75, make the math simple. And you'd be paying $1.75 to try to make $1.25. And you're saying in December, 44 days away, you're thinking the VIX would be below 16. Now, in this instance, a butterfly might work and it might lower the cost. So let's add let's go up one more here. And let's modify this. This is $3, right? So let's go $2 and buy. Yeah. Now that's interesting. So the modified butterfly actually works and we get the price down lower than the initial spread. So I'll throw this in the what if calculator. I'm going to take a picture of this. If I was going to go out to December, I would probably do this, implying I don't mind if the market goes below 14, but we're 3 points wide on our long spread and 2 points wide on our short spread. Let's send this to the what if calculator. And I'm asking the producer, do we have any questions out there at this point in time? And I'm going to take that as a no. So if I look at this, if I do this trade and the VIX actually ended up, it does kind of screw it up a little bit. We're paying $1. And if it goes to 14 on down, we would just be break even. So we'd do this trade and the money would sit out there and the VIX actually went below 16 and went all the way down to 14, we would just be at break even on the trade. If we can make a quarter, it would be worth it on $1. But this is the December, and we bring the cost down from 175 down to $1. That's a big deal. It's worth looking at. It's worth looking at. All right. Well, I'm long. I'm long. I'm not long on the market this week. As a matter of fact, if I were to do anything, I'd say I would stay the neutral volatile outlook for the week. Need to get this event beyond, and then looking to. I got some cash that I'll look to go a little bit just long the market after the election. So with that said, that's it for this edition of Options Guy TV. We got our Palantir trade on, and that's just basically something to look at when we come back on Wednesday after the election. The big trade is obviously the VIX. And once again, it's not meant to be a recommendation. We're just saying that whenever we do anything here on Options Guy TV, we are just trying to learn. We don't know anything about your portfolio. This is a very speculative trade to do the VIX. Please check out my article, Decoding the VIX, at Options at Brian Overby, at my name, inside Twitter. And thanks for stopping, and go out and vote. See you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.